How to make money with lease options to buy real estate. Have you heard of lease options as a means to profit from investing in real estate? If not, you will do it today. Luckily for you, Real Talker, I'm going to show you the basic, tried and true methods for making money with lease options. You'll adore it, I can tell. Advanced real estate investors might utilize lease options as a mechanism to sell properties from their holdings. Renters who are still unsure about whether to buy a property can use a lease option to rent it out for a while. In other words, a lease option is a special instrument that offers flexibility to both landlords and tenants. You must comprehend how leasing options operate and what the restrictions are in order to use them effectively. Learn more about leasing alternatives in the following paragraphs, including how they operate, what they entail, and whether you would be a good candidate. What is a lease option? Initial differences between leasing options and conventional mortgage arrangements. An investor who has a lease option has a property they wish to sell, but not right away. In order to increase your passive income, you must determine that you wish to rent it out temporarily. As a result, you provide renting with the option to buy, sometimes referred to as rent to own, which is known as a lease option. Typically, you will give your tenant buyers a set amount of time, usually between 2 and 5 years, in which to purchase the home. They will continue to pay your rent throughout this time, and you will close on the house if they decide to buy within the predetermined window of time. The beauty of this arrangement is that it presents a wonderful opportunity for everyone concerned, because not everyone qualifies for a typical mortgage due to poor credit, insufficient credit, etc. This gives them the chance to live in a home while they pay rent and raise their credit score. By providing a bridge for those in need, one can aid. How do lease options operate? In essence, a lease option enables a prospective buyer to rent a property from an investor or owner on a flexible basis without being obligated to purchase it at the conclusion of the lease term. In contrast to a standard lease purchase arrangement, a lease option permits the tenant to give up the right to buy the property if they decide to leave. At the beginning of the lease option agreement, the renter, potential buyer, and the property owner will normally come to an upfront agreement on the price of the property. Prices are typically set at the home or property's current market worth. This can be advantageous for the potential buyer because it implies that by the conclusion of their lease term, they may be able to buy the house for less than the going market price. However, owners frequently charge renter fees to exercise the lease option up to 1% of the home's total sale price. Requirements for lease options. Lease choices appear to be trade-offs for investors or property owners. When the lease term is up, they might be forced to sell the property to the tenant at a lower price than they could get if they sold it to another buyer. In exchange, residents are required to pay a higher rent amount than usual. In addition, there are a number of prerequisites for tenants to be eligible for lease choices. An owner of a property with a lease option will demand an additional fee on top of the usual monthly rent. This could be a fee of some kind or a percentage added to the regular rent amount. If the renter chooses to exercise the option to purchase the property from the owner, this additional payment, known as the rent credit, typically becomes a part of the down payment for the house. If the tenant decides to purchase the house under the lease option, some banks might not allow the aforementioned premium or rent credit to be utilized as a down payment. If the rent was charged at market rate, this usually happens. Therefore, while renting a house with the intention of signing a lease option agreement, buyers should verify with several banks. Although they can be any duration that the landlord and tenant agree upon, lease option lengths are commonly between 1 and 3 years. The eventual prospective purchase price of the property must be specified in the lease option contract. No matter how market rates change over time, up or down, this purchasing price will not change. Why use a lease option? For tenants who don't mind paying a little bit more rent in exchange for the chance to acquire the property at the end of their lease, lease options are obviously fantastic deals. Additionally, the lease option allows customers flexibility because they are not required to buy the house at the end of the lease period. Instead, they have the choice to walk away if they find a better deal or if their personal circumstances force them to change their minds. Additionally, if a tenant doesn't currently have enough funds to pay a down payment, they may negotiate a lease option agreement. They can take advantage of the premium credit by renting and save enough money to cover the down payment, which will hypothetically lower the down payment required to purchase the property. Renters gain even more as they eventually purchase the property at lower market rates. They won't need to be concerned about the market rate rising later. For several reasons, owners may also choose to participate in the lease option. For instance, a homeowner might have trouble selling a home outright yet have no trouble finding renters. By doing this, they can continue to get revenue from the property and have the option of a full sale in the future. Additionally, landlords are permitted to charge premium rent to their tenants. That is, rent that is higher than the going rate on the market. More immediate earnings are generated as a result. Since the premium money isn't used as a down payment for the home, they belong to the renter if they decide not to purchase it. The property owner's decision to enter into a lease option agreement may also be calculated. For instance, if selling the property now might result in tax problems, they could wait for the tax concerns to be resolved and possibly sell the property later. Considerable lease option variables. Think about both homeowners' insurance and renters' insurance. Renters' insurance should be carried by the tenant and covers any loss of value for furnishings and personal property. In the event that something unfavorable occurs during the lease term, such as a fire or water damage, the homeowner should have their own separate insurance coverage to preserve the home value. Additionally, make sure your lease option agreement contains an appraisal contingency. Before the sale is finalized, the appraisal is used to determine the precise sum that will be due to the property owner at the end of the lease term. An updated home value and price will be determined by requiring an appraisal, just in case the home's worth rose or fell during the term of the lease. How to invest in real estate using a lease option. You can creatively invest in real estate in a number of ways by using a lease option. A straightforward lease option might be provided. You will take on the role of the property's owner or lessor in this scenario. You'll locate a tenant buyer, sign a lease option agreement with them, and either sell the property at some point or go through a number of tenant buyers before you get one who actually closes the deal. In that situation, you would still serve as the investor. You may also be the lessee. In this case, you would sign the lease option contract with the owner of the property with the intention of subletting it to someone else. While this is going on, the landlord charges you the least amount of rent feasible. The difference in money you receive from your tenant for subletting can be divided between you and the property owner. The lease option sandwich technique, which involves acting as a lessee and locating the property where they can get a lease option from an owner, may be tried by more experienced investors. The investors then locates a fantastic tenant seeking a rent-to-own deal. The potential tenant is signed by the investor with a lease option for the same property and they pocket the cash difference. As you can see, lease options are a terrific way to enter the real estate investing market and a smart way to buy a house if you don't have the money on hand for a down payment. If you're the lessor, you're responsible for selling your property to your tenant if they exercise the option to purchase it at the conclusion of their lease term. So carefully weigh the aforementioned options. With lease options, how do you get paid? The enjoyable part is here now: money. The lease option procedure will be started once you have your property and have identified a tenant buyer. The three methods your tenant buyer will compensate you are as follows. Number 1, option sum, a non-refundable fee used to reserve the rental arrangement with you for the house they want to purchase in the future. Number 2, the difference between the monthly payment you get from your tenant buyer and the amount you still owe to the original purchaser of the property each month is known as the monthly rent premium. Number 3, tenant buyer closes on the property and pays the predetermined value agreed upon at the beginning of the rental period. This is the property's final sale. Case study to see how money is made with lease options. Imagine you've located a house to buy that is owner financed. Your original contract with the seller stated that you would pay $750 per month in rent, put no money down when purchasing the property for $100,000, and had 5 years to pay it off. The property is free and clear, and over those 5 years, the seller has consented to putting all of your rent toward the $100,000 principal, goes towards the principal. Additionally, the house's after repair value, ARV, which corresponds to the price at which you're listing it, is $120,000. The property is then sold to a tenant buyer. The tenant buyer has 2 years to obtain a mortgage for the $120,000. They will pay you $1,000 per month in rent, and you will contribute 20% of that amount to the principal. Additionally, the tenant buyer will pay you a non-refundable choice fee equal to 10% of the purchase price, $12,000, before you move into the rental home. It is yours to keep the choice cost. You can contribute a portion of the option fee toward the purchase price, but that is entirely up to you. If the tenant buyer decides not to purchase the property, you will receive that money. Even the portion of the rent that would have been used to reduce the principal is yours to keep, together with the option fee. Let's assume that's what actually occurs in this case study. After a year, your tenant buyer decides that they no longer desire the house and leaves. If that occurs, you then locate a new tenant buyer and repeat the process. They'll give you another option fee, after which they'll start afresh with their rent payments. However, let's imagine that this time, the option fee is $15,000 non-refundable. Everything else about the transaction is the same: $120,000 for the property, 2 years to pay it off, and a $1,000 monthly rental fee with 20% going toward the mortgage. Can you see the money coming in? At this point, you have received $20,000 in option fees, non-refundable. That's the first way you get paid. The second is through rent premiums. You have been paid a $250 rent premium each month, which is the difference between the $1,000 your tenant buyer has given you and the $750 you are required to pay the seller each month. Let's assume that at the end of the second year, the second tenant buyer is prepared to purchase the property. You made $9,000 from the rent premiums alone if the first tenant purchaser stayed there for a year and the second tenant buyers stayed there for 2 years. It costs $36,000 when the option fees are added on. Just the choice fees and rent charges add up to that. Now, let's look at the third way to get paid: the final sale of the property. When their 2 years are up, the second tenant buyer is prepared to close. They choose to obtain a mortgage and settle their outstanding debt. This indicates that the tenant buyer will reimburse you for the remaining $120,000 of the purchase price. Additionally, you shall reimburse the original vendor for any outstanding amounts. You have been using the $750 each month to reduce your principal, so keep that in mind. Thus, after 3 years, you will have paid off $27,000 of your debt, leaving you with a balance of only $73,000. However, your tenant buyer has also been reducing the principal amount payable. Say you decide that $10,000 of their $15,000 option fee can be applied to their outstanding principal debt. Additionally, 20% of their monthly rent for the next 2 years has been deducted. Add an additional $4,800 to that. They will subtract the aggregate amount of $14,800 from the $120,000, leaving them with a balance of $105,200. This is the last payment method for this property. You owe the original seller $73,000. Thus, the renter-buyer is paying you $105,200, leaving you with a profit of $32,200. By the time the deal closes, you will have profited $68,200. When you add this to the $36,000 you have already earned from the property, after option fees and monthly rent premium, that is almost $70,000 from a single home in which you have made no financial investments. That's amazing! This is why I love lease options. I don't know any agent in the world who can make $70,000 from a $100,000 house if they list it. Do you? No bank, no credit checks, no lengthy closing process. It rocks! Lease options are the best. To assist those who are in need of financial support, nothing is better than discovering fantastic offers. The benefit of providing this service is that you benefit financially as a result. I'm hoping you recognize the potential that Lease Choices offer. To learn about all your accomplishments would be wonderful. That's it for this video, Real Talker. Remember to subscribe to our channel, and if you feel like we've delivered value, please share this video with one person. That's right, just one person, as a token of your appreciation for the hard work we put into making content that educates and helps you on your mission of building your own fortune. Remember, you can watch video after video, but it isn't until you actually take action that you'll start to see results. See you soon!